Okay, welcome back to the Quiet Signal. Welcome, welcome, welcome. To get started, I would love to mention this is a new channel. We're just starting out. I'm looking for subscribers. I'm looking for likes. I'm looking for shares. I'm looking for comments. So if you've got anything like that inside of you to offer, I would gladly take it. So let's jump into it. Today I'm talking about BlackRock. The reason I wanted to talk about BlackRock today was I didn't feel very confident in my personal life when I was discussing the topic. I was kind of let down by my ignorance. I just have this kind of visceral disgust with BlackRock and the sort of situation going on with it. So I felt like coming up with a little bit of an overview of BlackRock and some criticism of it. So without further ado, let's jump into it. So BlackRock, in the vast, intricate machinery of global capitalism, there exists a powerful but largely invisible force shaping everything. From the value of your retirement account to the policies of the world's largest corporations, BlackRock. With over 10 trillion in assets under management as of 2025, BlackRock is not just the largest asset management firm in the world, it is arguably the most influential non-government institution on the planet. But with that influence comes increasing scrutiny, particularly from critics like Ian Carroll. If you're familiar, Ian Carroll on the Joe Rogan Experience and host of the Candace Owens Show. He's gone a long way in the last 2-3 years since he was just a humble TikToker talking about tampons. There's also a growing chorus of skeptics who see BlackRock as emblematic of a troubling consolidation of power in the hands of the few. BlackRock was founded in 1988 by Larry Fink and a small group of partners. They began as a risk management and fixed income institutional asset manager. The firm grew rapidly through the 90s and 2000s, acquiring Merrill Lynch Investment Managers in '06 and Barclays Global Investor BGI in '09. The BGI acquisition brought with it iShares, now the world's largest family of exchange-traded funds. This growth was not just in size, but in scope. Today, BlackRock manages portfolios for governments, pension funds, universities, and everyday retail investors, meaning, most government employees, their 401ks, their retirement accounts, so that's teachers, DMV employees, pension funds, so like the police pensions are commonly invested with BlackRock. All sorts of things like that. So they control a lot. Its proprietary risk management software platform, Aladdin. I remember when this was, kind of a breaking thing. Aladdin was big news when it came out. It's used by hundreds of institutions to manage portfolios and assess risk. Still, BlackRock operates in a unique twilight space between the public and private sectors. It advises governments on financial crises, it's helped central banks manage their balance sheets, and even managed portions of the COVID-19 economic recovery. So this hybrid nature that critics argue gives BlackRock a dangerous amount of unchecked power. So to talk a little bit about Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network, is the proprietary software platform that BlackRock built and now licenses out to over 200 institutions. So this platform analyzes trillions of dollars in assets daily, measuring risk, simulating economic outcomes, and suggesting portfolio adjustments. So on the surface, this is just smart financial engineering, but critics will argue that Aladdin represents something deeper. It's a central nervous system for the global economy controlled by a private corporation. When the same firm that owns massive stakes in the world's largest company also controls the risk modeling tools used by major banks, insurance companies, and pension funds, it raises the specter of systemic bias, groupthink, and an unhealthy dependence on one black box system. People argue that this creates a dangerous monoculture in global finance. Just as biodiversity is necessary for a healthy ecosystem, diversity of thought and strategy is essential in finance. If too many actors rely on same models, even small errors in these models can have cascading global consequences. This is like when people come up mentioned where people have the idea that capitalism naturally evolves into communism. This I feel like is this is an instrument of that effect, right? Where there's sort of a monopoly effect in global finance, where you end up with one institution consolidating and owning, merging, and acquisitioning everything into itself, and it just becomes one thing, and then that becomes a centralized power that controls all of the financial world. So it's kind of spooky. So a key part of BlackRock's growth story is its dominance in passive investing. Through its iShares ETF products, BlackRock has made it easier than ever for everyday investors to gain exposure to the stock market. These funds simply track indexes like the S&P 500, buying and holding the stocks in proportion to their weight in the index. But passive investing has an ironic consequence. BlackRock ends up holding enormous stakes in major corporations without having to make active investment decisions. So you think about this. I mean, I think Michael Burry has mentioned this. I know all of the stuff everybody says about Michael Burry, but there is this passive investment bubble that people point to where everyone knows that they have to have a 401k now. Your dollar is being inflated. It's losing its value. Every dollar you earn is rapidly losing its worth the second you have it. So you have to transmute. You have to change that dollar into something of value, whether it's gold or reinvesting into your business, etc., etc. But what most people do, because we've been told to do this, is you put it into your retirement account or you invest it in some way. So you throw it into one of these ETFs rather than buying individual shares, which is risky and requires thinking. You want to passively invest. So everybody just for no reason at all just says, okay, I'm going to throw my money into an ETF, and with that comes sort of artificial inflation of value in those ETFs. Everybody's just tossing it in because, without actually thinking about why they're throwing their money into these things, and so that creates a sort of artificial increase in its value because people aren't being critical of what they're investing in. So it raises a host of concerns. Who is really governing these companies? Right. So you surrender when you invest into these ETFs or into a mutual fund and whatnot. You kind of surrender your rights as a shareholder. Like, you're not actively voting or participating in the company. You are investing inside of someone else's house, and then that house is on your behalf using your shares and your power for their own means. Who's deciding CEO pay, mergers and acquisitions, or environmental policies? While BlackRock claims to act as a responsible steward of investor capital, its voting record and the while BlackRock claims to act as a responsible steward of investment capital, its voting record and the occupancy of its decisions have left critics skeptical. Furthermore, there is a concern about common ownership, the idea that when one firm owns significant stakes in competing companies, it may dampen competition and lead to higher prices for consumers. This issue has caught the attention of antitrust scholars, though regulatory bodies have been slow to act. That meaning, like when BlackRock owns, for instance, this is a hypothetical dynamic, but you own Target and Walmart. Target and Walmart are no longer really competing with each other in a natural sense. They're actually just two different arms of the same beast. That's where you run into, things like where Ian Carroll points out, you go to a grocery store, all of these different brands on the shelf are not actually competing with each other. They're all owned by the same few corporations. They're just different flavors of the same company. And that's the anxiety with this sort of consolidation effect that BlackRock has. Moving on, let's talk about ESG, virtue or ventriloquism. In recent years, BlackRock has tried to position itself as a champion of environmental, social, and governance investing. Larry Fink's annual letters to CEOs have emphasized sustainability and climate risk as central to investment decisions. The company has voted to push climate disclosures and even divest from some fossil fuel companies. To some, this is a wholesome evolution, but to others, it is a cynical marketing strategy. Critics point out that BlackRock continues to invest in fossil fuels, defense contractors, and authoritarian regimes. People suggest that ESG is less about real impact and more about optics, a way for BlackRock to appear progressive while continuing to profit from the status quo. The ESG push has also led to backlash from the political right, particularly in the United States, where some states have sought to ban BlackRock from managing public pension funds over what they view as political activism disguised as investing. Everybody has a certain flag during certain months because of the ESG push coming from BlackRock. Perhaps the most disturbing criticism of BlackRock lies in its relationship with the state. During the 2008 financial crisis and again during the COVID-19 pandemic, BlackRock was tapped by the Federal Reserve and the U.S. Treasury to help manage bailout programs and stabilize financial markets. That's a lot of power. Who are they going to choose to bail out? Who are they going to choose to help? Probably people that they are invested with. While this might seem like a pragmatic choice, after all, who better to manage large pools of money than the biggest asset manager? It raises serious questions about conflicts of interest. In some cases, BlackRock was tasked with purchasing bonds and ETF that include its own products. It was both the referee and a player. This blurring of lines between private power and public governance echoes themes that concern people, that the creation of a shadow government in finance where decisions that affect millions are not made by elected officials but by technocrats at a handful of powerful firms. Black hole effect. BlackRock's reach is so vast and its operations so complex that it often escapes scrutiny simply because it's too large and arcane for the average person to understand. This is sometimes called a black hole effect. Power so diffuse and opaque that it absorbs accountability. The company doesn't directly make headlines like a big bank collapses would. Instead, it exists in the background, shaping markets, influencing boards, writing letters to CEOs, and modeling economic risk for hundreds of institutions. Its influence is felt but not always seen. The critics argue that this is by design. A truly democratic system cannot function properly if too much economic power is held in the hands of unelected, unaccountable actors, they say. Okay, in conclusion, BlackRock is not a villain in a comic book. It employs thousands of talented professionals, builds powerful financial tools, and manages money for millions of retirees. But its size and scope make it a unique institution, one whose influence is difficult to overstate. What critics bring to the surface is not BlackRock is evil, but that is emblematic of a larger system that concentrates economic power in dangerously few hands. The combination of technological control via Aladdin, financial dominance via passive investing, and political influence via government contracts create a trifecta that demands public examination. In a time when trust in institutions is low and inequality is rising, allowing one firm to become so central to the global financial system is a gamble. If nothing else, BlackRock should serve as a wake-up call, a reminder that the future of capitalism will not be written only by governments or voters, but also by quiet giants who manage our money while remaining largely unseen. Transparency, accountability, and structural reform are not just desirable in the age of BlackRock. They may be essential for the survival of a truly democratic economy. Thank you.